Hi, I'm Will Rhode. I'm Director of Fixed Income Research at TABB Group, and I'm joined today by Dom Holland, who heads up credit e-commerce sales at Deutsche Bank in London, and he's come over to New York to talk to us a little bit about a new initiative he's got going on in terms of a collaborative approach to the corporate bond trading dilemma. Dom, why don't you tell us a little bit about what you've got going on?
We've been talking to clients and to the trading platforms that we participate in, as well as some of our peers of late. There's an enormous amount of noise and frustration about illiquidity within the secondary bond market, and some considerable concerns about how when the new issue market starts to close or interest rates start rising, how the non-function of the secondary market may impact returns and investors' ability to move positions and to re-enter sort of relative value trades.
Yeah, I mean, that's exactly what we've been thinking about for the past year, but it seems to me one of the hallmarks of this market is fragmentation. You see fragmentation in the primary market, you see fragmentation in terms of secondary market offerings. There's even a fragmented conversation going on. What are you thinking about in terms of kind of just pulling this together into a cohesive, collaborative approach?
Well, in these bilateral conversations, it becomes obvious that there are many initiatives happening. Many of them are good, but I think the fragmentation is causing confusion and a lack of momentum towards a consolidated approach. So we're looking to work together with all sides of the industry.
Buy side and sell side?
Buy side and sell side. Okay. And to create a marketplace which would concentrate liquidity and see more activity in some of the less frequently traded CUSIPs and ISINs.
And is that a multi-dealer platform? What are you thinking about?
Well, we're thinking that the big impediment at the moment to an exchange of risk within the marketplace is the sell side isn't incentivized to put its capital to work the way it was historically.
It's more expensive as well.
Much more expensive. There's some concern around the regulatory environment, which is causing more caution and putting that capital to work.
Are you talking about MiFID in Europe? Are you talking about Basel? Are you talking about the Volcker rule, or all of the above?
I think all of the above is a huge cloud of uncertainty that's hanging over the marketplace, whether you're sitting in the US or whether you're sitting in Europe.
Okay.
So I think it's a major contributory factor to making people behave more conservatively and more cautiously about capital commitment to the marketplace.
Okay.
I think on the other side, clients have become nervous about the opportunity to exit positions. I think they've concentrated their strategies much more passively. We're seeing ETFs, we're seeing many more index tracking, we're seeing people being much more conservative. So they're starting to mirror each other a lot more closely, which again is causing a concentration of activity in a smaller number of ISINs.
Right, and they'll be exposed once QE ends and volatility returns.
Absolutely. And the fear there, I think, is to try and exit some of their other positions that they have in portfolio. The leakage of information pre-trade is having such a negative market impact, even at the idea of a trade, before a trade even occurs.
Right.
So we're looking at a model that would allow multiple participants to get together in an environment that would incentivize relationship, incentivize the use of capital into the marketplace, but at the same time give protection of that information leakage pre-trade, so that we can ensure that motivated buyers and sellers meet each other and don't get lost in the noise that's currently in the marketplace.
Okay, so say if two customers were going to trade with each other, they might be able to somehow express an indication of interest across this network, but the deal would be intermediated by a dealer still on both sides of the trade. Is that what you're talking about?
Well, there's been a large call from the buy side, looking at the fact that they have increased the assets under management over the last 5 or so years at an exponential rate, and that the balance sheet transfer really has happened from the sell side to the buy side.
Right.
So a large call for an all-to-all type model, exchange type. But when we analyse the data of client activity, we think the crossing opportunities are fairly small, and therefore the dealer capital is still needed to grease the wheels of trades.
Got it.
So we've got to find a way that helps us to evolve from a principal at risk model to a more agency model.
Understood.
And we're looking at an evolutionary approach rather than a revolutionary approach.
Got it. Okay, I understand. So the dealer will continue to intermediate the trading process, but this will give them an ability to offset the trade into the marketplace more efficiently without it sitting on their balance sheet for a long period of time.
Exactly.
Got it. Understood.
And in positions where they're not adding anything to the transaction and it is a pure agency cross,
right,
then it's just an information exchange to maintain relationship, that dealers can use to propagate further trades within the marketplace, or to advise their borrowers in the new issue market, the corporate treasurers and those people.
And they won't be charging an arm and a leg to stick it into their balance sheet.
I think that would be a very poor way of putting it forward.
Okay, so what is the reception that you've had to this idea? What are the conversations? You're over here talking to folks in the US. What's it been? Europe, US? What are you seeing?
I think in Europe the noise from clients and dealers is the same on both sides of the Atlantic. Mm-hmm. I think the motivation is slightly different. So in Europe, we've got a market that's created a liquidity mirage. Everyone streams thousands of two-way prices through the electronic ECNs that already exist, often not actually having a position or an intention to trade. Mm-hmm. So that's creating a high percentage of unwanted trades.
Right.
It's also causing a mismatch of smaller trades and positions, which is sucking capital out of the street. So I think in Europe, the dealers are much more open to a new model that changes the current behavior and gets them away from the reputational risk that they perceive if they don't stream thousands of prices, and gets us to a better way of matching these motivated buyers and sellers to get trades done.
And what about here in the US?
I think in the US, the market, which is less electronic, works very well as an analog voice market, and I think that we're seeing the noise here is much more from the client side, from the buy side. I think they're agitating for change, and I think the dealer community are getting their head around that, but are going through a learning process as to what the long-term ramifications for a very stark model change would be.
I mean, I think part of the challenge there is, of course, the fact that I think it needs dealer facilitation to make something work. And if there's less of a capital pressure here, perhaps because of a different timeline for Basel in the US, then why bother changing it, right?
I think that's been a really large factor, but it's certainly in this year, in 2013, I've noticed a step change with the larger dealers to want to be around the table, to understanding that there are probably large opportunities if they can increase the activity in the secondary market, and probably a realization that even if Basel III isn't going to come in the same time frame here, that the implications for the secondary market in a rising rate environment and with QE maybe being withdrawn, then that's going to have serious implications for future revenues. So I think the conversations are progressing quite quickly, and I think that the level of engagement has increased from the sales side in the US of late.
So when do you think this thing will actually see the light of day?
I would hope it's much sooner rather than later. Mm-hmm. What we've done so far is try and talk to the market participants, so the buy and sell side people, to come up with ideas around what protocols would work to incentivize everyone to participate.
Right.
Shortly we will be in a position where we can put all of those interested parties together, those that have been most vociferous, those that have come forward with good ideas and high levels of engagement, and hopefully we will get that finalised as some form of straw man that we can hand over to a technology provider, who would then be able to execute the strategy.
So it won't be Deutsche Bank's idea. It will be an independent technology vendor will be the front end of it.
Absolutely. This is a collaborative effort amongst many people in the marketplace. So we are talking to our peer group, we are talking to the other dealers. They are actively engaged in conversations, and we're gleaning information from all round. But we've been very keen to remain as a sort of industry-led solution about what's really wrong with our marketplace, and then hand that to someone who we think will be best placed to deliver that.
Okay, it's good news to see the sell side listening to the buy side, and good to see a collaborative approach and sort of combat some of this fragmentation that we've been seeing in the market. So thanks a lot, Dom, for coming in and telling us about what you're doing.
Pleasure, thanks for having me in.
Thank you.